my next guest says that he is increasingly confident that Europe's leaders will, in fact, get a grip on the debt crisis. Kevin Lecocq is Chief Investment Officer at Deutsche Bank's Private Wealth Management Unit. He oversees $202 billion in assets. Kevin, welcome. So why do you think that we might actually see a fairly good outcome from all these meetings and negotiations taking place? What's behind your confidence?
Two things, Maryam. First, the longer-term structural issues around Europe have been well addressed by politicians for the last 30, 40 years. Time and time again, they come to the rescue of the European project. And while the way in which they do it is not often linear or immediate, they usually get to a good solution. Technically, on a shorter-term basis, we're getting the right kind of noises both from Berlin and Paris that some kind of an accord will be reached in the kind of time frame that the markets demand.
And interestingly, you're saying that any potential solution could actually involve some sort of US-style TARP framework, don't you? And that would also involve an orderly restructuring of Greece, and the EFSF would recapitalize the banks. Now, I mean, these are three issues which they haven't really gotten to grips with over the past year and a half. Do you think that that would really happen this year?
The way we're analyzing things is that the probability of a success has gone up, not that success is at all guaranteed. In other words, the way we're playing it is we're feeling that the probability is quite improved that they'll get the right kind of resolution to this. The downside, of course, is still extraordinarily severe, but the probability of that perhaps is lightening a bit.
So with that in mind, we see markets perking up a little bit on the expectation that we will get, there seems to be this perceived willingness, if you like, of European leaders to come to some sort of agreement. You know, we've got two big meetings coming up, October 23rd and then the big one, G20, November 3rd. Is this sort of market optimism, even if it is cautious optimism, justified?
Well, I think there are two things driving markets in the short term here. One is that assessment that a positive outcome is increasingly likely, although not a done deal. And the second is I think the markets had been very oversold, and there were a lot of short positions that probably need to be squared up. And so it's a bit of a short covering rally as well. But there's real fundamentals behind it, too.
Like, such as?
The way in which bank stocks are starting to behave now, we're starting to see improved funding conditions. Very importantly, the ECB injected or offered to inject massive amounts of liquidity and term liquidity for bank funding at the ECB conference last week. We feel that's much more important than a rate cut.
All right, so you took some heart from the fact that the ECB took additional measures there to help shore up the banks. But I'm just wondering that if the strains that we've seen in the markets over the past month continue, will funding for the banks become even more of a challenge than the ECB can currently help with?
I think that's the real risk, Maryam. I think that and the politicians understand this very well, policymakers, that if they don't come up to a resolution by the November 3rd deadline, it's really a very problematic situation.
And then in terms of your macroeconomic outlook, you're saying that actually PMI is suggesting at the moment that the Eurozone is likely to stagnate in the second half of 2011. This is your sort of broader outlook, if you like, for the region. Are we already seeing that happening now? And actually, could it get a lot worse by the time we reach the end of the year? Recession, potentially?
Well, what we think is we're getting a modest slowdown, and we'll probably get for the Eurozone in this fourth quarter and the first quarter of next year around zero real growth. Hopefully that'll perk up again in 2012, but we're definitely having a deceleration. And the economy, of course, has a memory over what's happened the past few months and a fair amount of uncertainty. And so there is a real slowdown in the Eurozone. However, the U.S. is perking up quite nicely, and we're fairly optimistic that we'll get some good numbers posting there.
So you're bullish on the U.S. next year? You think things will continue to pick up?
Well, we're bullish on the equity market and on the credit markets in the U.S. The economy itself is still struggling under a number of very significant headwinds, but the corporate sector is in extremely good health and continues to be so as long as the economy doesn't plunge into another recession, which is not our case.
Yeah, but then I suppose then there are also concerns, aside from the internal headwinds that the U.S. economy is facing, risks from the European sovereign debt crisis. You know, we're already expecting that to play a role in JP Morgan's earnings. We saw the same thing with Alcoa. I mean, what is the likelihood of guidance or the sort of outlook for some of these companies being revised down in terms, you know, even if their earnings are just about okay for the third quarter, what does this mean for next year?
Yeah, so we'll probably get an earnings growth slowdown, but they won't start to revert. And so for the S&P, we'll still look at over $100 in earnings for the S&P. So while it's slowing down, it's still in a positive territory in terms of growth.
I want to ask you, Kevin, how then this is reflected in your strategy?
Well, again, the way we're looking at the world is there's two very distinct possibilities, and the probability of those are evolving and changing. There's the positive outcome that we get a good resolution in Europe, and then the very negative outcome where the politicians and policymakers can't come together. And we've seen an evolution of that probability increasing to the favorable side, but we still are managing for a very, very ugly outcome, but with a lower probability.
All right, so in terms of your actual investment strategy or asset allocation, if you like, you're not too keen on gold and treasuries, on U.S. treasuries. Why is that?
Well, those have been great defensive plays over the last several months, and in our portfolio management, we use those as shock absorbers to the system. So they're very valuable for that purpose, but as the probability of a negative outcome starts to diminish, we're starting to take profit on those and see that there's not a real great fundamental reason to be owning treasuries at these sort of yields if the economy picks up a little bit.
And how do they compare with, say, S&P 500 dividend yields?
They're quite a bit lower. Very historic divergence in how earnings yields and dividend yields are now much more favorable to treasuries. And there's good reasons for that. There's a fair amount of uncertainty around equities and a fair amount of risk.
Well, that's what I was going to say. That's the risk in investing right now in high dividend-paying stocks is just this level of economic uncertainty. We keep talking about it, but these problems are there.
Absolutely. And, it's going to take a decade or more to work off the credit crunch. But the economies are fairly, underneath it all, can recover a lot of this crisis through earnings power.
Okay, so where do you stand then on fixed income apart from U.S. Treasuries?
Well, we like the credit space very much, and now as we're getting a little more confident about the U.S. economy, somewhat more confident about the East Asian economies, we're moving up into more high-yield fixed income and away from the very highest grade corporates, because they've really widened out quite a bit in the last several months.
So you're avoiding corporate bonds?
No, we're moving into riskier corporate bonds.
Riskier corporate bonds.
Higher yield bonds.
Why is that?
Because we feel that the probabilities of default have been overly priced by the market currently and recovery, and that the underlying cash flows of many of these companies is very sustainable in terms of their debt coverage.
And so it sounds like you're really betting the macroeconomic situation will improve.
Well, that's what we're shifting, Maryam, is the probabilities. Okay. Again, it's not 100% certainty, and to predict political outcomes is rife with problems.
And I'm curious, why do you see potential in emerging market bonds?
Again, these were kind of the last risk assets to get sold in this August-September sell-off. And these are the bonds and the assets that were most treasured and most loved by many investors, mostly because they have great fundamentals. And the liquidation that occurred were really risk management liquidation, and we feel that over the next several months, these will offer good value as investors come back in.
I'm just wondering, in this climate of intense volatility, unpredictability, it's very difficult to see where we might go next. Generally speaking, where do you stand on risk assets?
Well, we pared back enormously our risk assets in early August, and now we're starting to add back in. So while we're not fully risked up, as one might be, we're getting cautiously more optimistic that the political resolution and the economics are going to start to become no longer headwinds, perhaps not yet tailwinds, but no longer headwinds, and we can have a little bit smoother sailing as some of the fog clears on the situation here.
All right, so thanks very much indeed. Good to get your thoughts. Kevin Lecocq, Chief Investment Officer at Deutsche Bank.